Risk-based audit planning. We've just covered this point. Ideally, we'd list all organizational processes, then perform a risk assessment and focus on high-risk areas, right? Risk-based audit planning allocates resources to areas that pose the greatest risks to the organization. As we mentioned, right? After completing the risk assessment, we determine the audit scope. The risk-based approach can also assess, guiding auditors in choosing between compliance and substantive testing. It's a common exam question. What's often asked about this? While assessing risks, you'll understand that for a company, the internal control system during risk assessment with all these operations. Once you've evaluated everything, you've noticed that this company's internal controls are excellent, aren't they? There's a lot to consider in your risk assessment. What have you discovered? Well, their compliance is likely top-notch, wouldn't you say? Lots of policies, lots of details. So when you're actually implementing these processes, alright, in that case, you might reduce the frequency of compliance testing. You'd conduct it less often. Makes sense, right? Since the initial assessment showed high compliance, and the compliance level was high when it comes to risk assessments, you'd naturally reduce your testing efforts. Compliance testing checks if standards are met, so you'd do less of it in this case. However, if during your risk assessment, you find the company is missing everything it should have, the internal control system is inadequate. How do we address this? In the actual audit process, you'll need to increase the scope of substantive testing. Understood? Given the numerous compliance issues, there's little point in focusing on compliance testing. Instead, focus substantive testing on physical assets. Is that clear? We'll revisit this topic later if necessary. Alright, it's noon now. That wraps up our morning session. For the afternoon, we'll reconvene at 1:30 sharp. Weren't the transaction logs supposed to go to the audit manager first? What's the problem with the transaction logs? What's this about giving it to the audit manager first? Can you say that again? I'm not sure which part you're referring to. Do we have the transaction logs? What's the issue here? It goes to the audit manager first. When it comes to reporting, we're talking about submitting to the committee. Remember, reporting here means major violations or illegal activities. For issues involving violations or illegal activities, these must be reported to senior management, not to the audit manager. Got it. Follow the guidelines on when to report to audit and when to communicate with the audit manager. When you issue an audit report, it must first be approved by the audit manager. Let's double check this. Okay? Got it. For the exam, I want to stress again, if you uncover any misconduct, report directly to top management, the audit committee, or senior management or the board, not the audit manager. Okay? So when you talk to the audit manager before releasing the audit report, first discuss with the audit manager, then release the report. This is one key difference between the two you see. Pay attention to this, folks. Alright then, that wraps up our morning session. Thank you everyone. This afternoon, let's reconvene at 1:30 sharp, okay? Thanks again everyone! One more question about this creation and usage part. Does ITDC's effectiveness limit ITSC's effectiveness? When auditing applications controls, is it considered a special audit? So what exactly is a special audit? Let me break it down for you. Here's an example to illustrate. You'll get it right away. Remember when Japan had that big earthquake disaster? How did that nuclear plant leak affect us? After that incident in Japan, what were the consequences for China? Well, you'd be surprised by the actual impact. Our government, at the highest level, immediately suspended all nuclear power plant projects nationwide. So they decided to conduct a special audit to check our nuclear plants for similar risks and safety issues. So when do these special audits happen? Well, they're triggered when risk change or the environment shifts. These situations often call for special audits. Or if a company seriously violates regulations and we're in the same industry, we check if we have similar issues. That's when we conduct a special audit. So here's the thing. It all comes down to how we define this special audit. When you're auditing controls for a specific app that shouldn't automatically qualify as a special audit, right? Because even in your regular audits, you need to look at various things. During your annual audits, you also need to delve into application controls. So it's crucial to understand how this special audit is actually defined. And don't forget about the effectiveness of these IT application controls. It depends on how well the IT general controls work. Not certain about how effective your IT application controls are. What's this ASA you're talking about? And what about GC? What's that? Let's start with how you define this data. So what do you mean by XC and the GC in your data? Oh, I see. Application controls and general controls. Alright, so if I got your question right, you want to know how application controls relate to general controls, right? Well, about general controls. Regarding these general controls, let me explain it this way. For applications, we must meet specific standards for general controls. However, controls can vary between different applications. Your point that application effectiveness is limited by general controls is correct. In other words, general controls must meet standards first, then address specific application requirements. You need to implement specific controls and meet certain requirements. These general controls are also known as universal controls. It's really the foundation. This is the sequence auditors follow to gather information. During an audit, as we've just discussed, when you're auditing someone, you first need to understand their operations. You must get familiar with how they collect information, right? Then you move on to understanding their internal controls. Now, what's at the heart of internal controls? It's control risk assessment, isn't it? And it's crucial to understand their control measures. So what do we mean by control? In this context, it's about internal control. The level of risk in internal control is what we call control risk. Next, you determine if compliance testing is necessary. Then comes substantive testing. Finally, you summarize findings and write the audit report. Remember, compliance testing is always on the exam. Always. So what's this compliance testing all about? It's actually quite straightforward. Let me give you an example. Say you have certain rules in place or specific regulations. You follow me? In practice, you compare your actions to the established guidelines. Essentially, the question is, do you follow the rules or no? If you complain, it's a yes. If not, it's a no. Alright, to emphasize again about compliance testing. What's the key point? We have rules and guidelines in place. Throughout your implementation process, you need to check if everything aligns with these rules. It's a simple yes or no compliant or not. Compliance testing is all about answering yes or no questions. Got it. It's black and white compliant or non-compliant. See what I mean? It's pretty simple, really. The key point is this. We're checking if people follow company rules and procedures. Makes sense. This is what we call compliance testing. It's guaranteed to be on the exam. Let's get the concept straight first. What's the core and essence of substantive testing? Detailed counterbalance testing. I don't care about compliance anymore. You see, Whether you have one transaction or many, are the results of these transactions correct? You follow me? Is the balance sheet accurate? This is what we call substantive testing. Got it? It's the connection between these two. Audit risk. Now, regarding audit risk, it's influenced by inherent and control risks. Okay, this lecture, what do you need to understand? You need to grasp how these risks are interconnected. There's also detection risk. Let's examine audit risk. It's affected by inherent, control, and detection risks. These all have an impact. So what exactly do we mean by audit risk? Let's define audit risk. In a nutshell, when defining it, it can get a bit tongue-twisted. Let's put it this way. Audit risk occurs when the overall conclusion is flawed. That, in essence, is audit risk. Remember, a flawed audit conclusion. This clears serious misconduct, but your report says otherwise. Well, he meets all the criteria, doesn't he? It's clear as day he meets the requirements, but in your report you state, this guy's a walking disaster. This is what we refer as audit risk. So let's take a look at this first. We just said the conclusion was flawed. The official definition relates to the collected information, potentially containing errors during the audit process. Risk of overlooking major errors. Don't you think? How's that related? Let's start with inherent risk. What exactly is inherent risk? Let me give you an example. Take us regular folks. If we compare ourselves to cops, especially detectives, who's in more danger? Obviously, it's the police. But why is that? They're constantly on the front lines, facing off against criminals. They're always in the thick of it, which is why their casualty rates are so high even in peacetime, you see. Now, if we compare civilians to firefighters, who do you think faces more danger? Firefighters, even in times of peace, are a group with an incredibly high casualty rate. It's not uncommon to see dozens, even hundreds of casualties. This is especially true for firefighters. So why do they suffer more casualties than we do? What's the reason? It's due to the nature of their job. Isn't that so? Their line of work comes with higher inherent risk. We call this inherent risk, right? It's independent of other factors. It's inherent to the job, or rather, the nature of the work. So, about the nature of the work, let me give you an example. Let's say I own a small grocery store. You follow. Commercial. Got it. That's my line of work. Sell stuff. Make money. Day in, day out. Now compare that to someone trading financial futures. They're constantly hit by market fluctuations and face much higher risks. No doubt, it's the finance guys who have it tougher. But why is that? It's all down to the nature of their business. So let's talk about this. What exactly is inherent risk? It's the risk that's inherent to a particular profession or business due to its very nature. That's what we call inherent risk. So some professions and businesses have much higher inherent risks, right? So inherent risk isn't related to external factors or auditing. It has absolutely no connection whatsoever, not even a tiny bit. It's inherent, So inherent risk isn't influenced by audits at all. It stems from the business nature itself, or it's defined by the business specifics, right? This should clarify the concept of inherent risk for everyone. Now, let's turn to control risk. What exactly is control risk? It's about internal controls. Internal controls. That's on senior management. We're talking about your top executives here. They need to step up to the plate and pay close attention, of course. Wouldn't you agree? You must spot potential company weaknesses, then develop strategies to address them, right? Next, have your team create procedures based on these strategies. Manage any weaknesses found in your internal controls. This is what control means. Now, about internal control. When internal control is effective, it means lower risk, But if it's lossy, you're facing much higher risks. So in our everyday business operations, what does good internal control look like? A company has a wide range of rules and numerous procedural policies in place. Employees are required to follow these strictly. This right here is what good internal control looks like. Now, what about lousy internal control? It's total chaos. You have one idea today, a different one tomorrow, and yet another next month. Policies change as often as the weather. That, folks, is what we call terrible internal control. Alright, so control risk refers to the possibility that internal controls fail to prevent or detect errors in time without proper rules and procedures in place. How can you possibly prevent risks from materializing or catch issues early? Right, that's what we mean by control risk. Now, what about detection risk? Well, detection risk is tied to the auditing process. You see, now regarding control risk, we've already discussed this. It's about internal controls which involve senior management or management in general. Right, now audit detection risk occurs when there are clear issues as we mentioned before. For instance, problems in change management processes go undetected. In essence, issues have already arisen, yet auditors fail to detect these or address them in their statements. What do we call this type of risk? Detection risk. What factors influence detection risk? It depends on the auditor's skill set. Alright, and experience. If an auditor lacks skills and experience, it leads to a high detection risk. So ultimately, detection risk, how does it impact the overall audit risk? This shows how they're all connected. Now let's take a look at overall audit risk. Major errors in financial or information reports. As I briefly mentioned earlier, the conclusion is wrong. You see, the conclusion is wrong. Got it. Remember, we covered risk assessment in chapter 2. Let's skip this part for now. So what about the risks assessment process? We've talked about threats and vulnerabilities before. These are external factors. This refers to internal factors. Next, we have probability. These are the 4 conditions of impact, correct? Then we identify the risk. Sometimes we need to consider asset value upfront. The value, that is, alright. Now, let's talk about risk assessment techniques. What do auditors always focus on? High-risk areas, right? This point keeps recurring in our discussion. Once we've completed the risk assessment, we can establish our audit priorities. We've established our audit priorities. You see, out of 100 operations, 15 are high risk. So we focus our key resources on these high-risk areas. Got it. That's the gist of it. Now about risk analysis. We've touched on this before. It's about combining probability and impact. That's the basic idea. So when we're analyzing risks, this allows auditors to identify necessary risk mitigation controls. Wouldn't you agree? Once risks and vulnerabilities are identified, the next step is to assess appropriate control measures. What actions should we implement? Risk assessment is driven by business objectives. Next, we consider information assets. As I mentioned before, we need to focus on information assets. Regarding these assets, they exist to support business objectives. Finally, we assess threat vulnerabilities and their likelihood and potential impact. Once the assessment is done, we get our priorities. With priorities in place, what's the next step? It's risk mitigation. Right. Now, about risk mitigation. Remember, this is an actual exam question. What makes risk mitigation effective? It's matching risks to existing controls. Got it. Makes sense. How are your current control measures working out? We're dealing with a high-risk situation here. Wouldn't you agree? What would be the consequences if this risk materializes? What measures do you have in place right now? How do your current measures address this high-risk situation? How effective are they, really? You see what I'm getting at. On a scale of 1 to 10, how would you rate their effectiveness? Let's say they're only a 3 out of 10. So what additional measures do we need to put in place ASAP? or we might need to strengthen our approach. This involves mapping risks to our current control measures. We need to assess how well our existing measures mitigate this risk, you see. Are they completely effective? Or do we need to revise and strengthen them? Lastly, how do we handle the risk once we've taken action? We aim to reduce these identified risks. The goal is to minimize them. Remember, cost effectiveness is key in risk management. But what exactly do we mean by cost effectiveness? Let's revisit our previous example. Say you have a bike worth about $100. You can't just spend money on a lock, right? You're worried about theft, but you can't shell out $500 for a lock. That's just not worth it. When it comes to risk assessment, auditors in particular should note that if you identify potential risks, after identifying the risk, when proposing improvement measures, ensure they align with the cost-benefit principle. If the issue you've identified can be addressed, if implementing changes would be too costly, then it doesn't meet the cost-benefit standard. In such cases, the audit loses its value and purpose. Remember, the goal of risk management is to reduce risks to an acceptable level. As we discussed in Chapter 2, it's about reducing both the probability and impact of risks, or by transferring the risk